The choice between buying a home and renting one is among the biggest financial decisions that many adults make. But the costs of buying are more varied and complicated than for renting, making it hard to tell which is a better deal. To help you answer this question, our calculator takes the most important costs associated with buying or renting and compares the two options. Note that the winning choice is the one that makes more financial sense over the long run, not necessarily what you can afford today. And there are plenty of reasons you might want to rent or buy that are not financial. All we can help you with is the numbers. Methodology. The calculator keeps a running tally of the most common expenses of owning and renting. It also takes into account something known as opportunity cost, for example, the return you could have earned by investing your money, instead of spending it on a down payment, for example. The calculator assumes that the profit you would have made in your investments would have been taxed as long-term capital gains and adjusts the bottom line accordingly. The calculator tabulates opportunity costs for all parts of buying and renting. All figures are in current dollars. Note that tax law regarding deductions can have a significant effect on the relative benefits of buying, and that can change. For one portion of the mortgage interest deduction calculation, the calculator also assumes you make under $500,000 each year. Buying. Initial costs are the costs you incur when you go to the closing for the home you are purchasing. This includes the down payment and other fees. Recurring costs are expenses you will have to pay monthly or yearly in owning your home. These include mortgage payments, condo fees, or other community living fees, maintenance and renovation costs, property taxes, and homeowners insurance. A few items are tax deductible, up to a point, property taxes, the interest part of the mortgage payment, and, in some cases, a portion of the common charges. The resulting tax savings are accounted for in the buying total. If your house-related deductions are similar to or smaller than the standard deduction, you'll get little or no relative tax savings from buying. If your house-related deductions are large enough to make itemizing worthwhile, we only count as savings the amount above the standard deduction. Opportunity costs are calculated for the initial purchase costs and for the recurring costs. That will give you an idea of how much you could have made if you had invested your money instead of buying your home. Net proceeds is the amount of money you receive from the sale of your home minus the closing costs, which includes the broker's commission and other fees, the remaining principal balance that you pay to your mortgage bank, and any tax you have to pay on profit that exceeds your capital gains exclusion. If your total is negative, it means you have done very well. You made enough of a profit that it covered not only the cost of your home, but also all of your recurring expenses. When you decide to rent a place to live, there are several types of costs you need to consider. These include initial costs, recurring costs, opportunity costs, and net proceeds. Initial costs are the expenses you pay before moving in. They often include the security deposit, which is usually equal to 1 or 2 months of rent and is held by the landlord as protection against damage or unpaid rent. In some cases, you might also pay a broker's fee if you used an agent to help find your apartment. Other small upfront fees could include application fees or credit check charges. Altogether, these can add up to a significant amount before you even start paying rent. Recurring costs are what you pay every month while living in the rental. The main one is, of course, the monthly rent. In addition, most renters also pay for renter's insurance, which protects personal belongings from theft or damage. Depending on your lease, you may also need to cover utilities such as electricity, water, internet, or gas. These ongoing payments make up your regular housing expenses. Opportunity costs refer to the potential gains you miss out on by tying up your money in rent and deposits instead of investing it elsewhere. For example, the money used for your security deposit could have earned interest if placed in a savings account or other investment. These costs are often calculated each year to understand the financial trade-off of renting. Finally, net proceeds include any money you get back when your lease ends, most commonly, the return of your security deposit. If you've maintained the property well and have no outstanding rent or damages, you'll usually receive this deposit back. However, deductions may be made if the property needs repairs or cleaning. In short, renting involves a mix of upfront, ongoing, and hidden costs. Understanding these categories helps you plan your budget more accurately and decide whether renting is the right financial choice for you.